All right, future CPAs, let's talk about retained earnings. I know. It can be a total beast on the board exam, right? Well, think of this as your secret weapon. We're going to break down how to calculate distributable retained earnings so you can lock in those exam points. Let's get into it.
Okay, let's dive right in with a classic exam question. You see 10 million pesos in retained earnings on the books. So, can the company just give all that cash away to shareholders? The answer is a hard no, and the secret to acing your exam is knowing exactly why. This isn't just about protecting a company's finances. It's about showing the examiners you understand the core rules that keep companies afloat.
So before we even touch a calculator, we have to get the why. Seriously, if you master the why, the how becomes so much easier. And it all comes down to one core legal doctrine in the Philippines that you absolutely have to know for the exam.
Think of the trust fund doctrine as the golden rule of corporate finance. Basically, it means a company's capital is a safety net. It's there for anyone the company owes money to, like its suppliers or the bank. You can't just start giving pieces of that safety net away to shareholders. That's a huge no-go.
And here is where that big legal rule connects directly to the numbers you see on the financial statements. It all boils down to one key phrase you need to burn into your brain: unrestricted retained earnings. Get this term right, and you've pretty much cracked half the code for this topic.
Okay, so let's get into the official definition. This is pure LECPA gold. So listen up. We need to break down what unrestricted actually means according to the SEC.
So the biggest takeaway here is this. That total retained earnings number you see, that's just your starting point. Think of it as the gross number. You have to subtract all the stuff that's legally tied up or set aside by the board. Only then do you get to the net amount you can actually distribute.
Now, let's get to the stuff that examiners love to ask about. The new rules. The SEC dropped an update which makes this prime material for your exam. You absolutely cannot skip this part. You're going to want to memorize this. SEC Memorandum Circular Number 16, Series of 2023. This is the new playbook. It updates the old 2008 guidelines, and it gives us a much stricter formula for figuring out what's really available to be paid out as dividends.
And just so we're clear, this isn't some old rule we're studying for fun. This is live. It's the current, active regulation that applies to financial statements right now, which means it is 100% fair game for your board exam.
All right, this is the moment you've been waiting for, the actual step-by-step formula. Here's a study hack for you. Don't think of this as just a calculation. Think of it as a filter that purifies your retained earnings number. And here's that process laid out. It's a pretty simple 4-step flow. You start with the book amount, and then you just strip out everything that isn't real hard profit. Now pay super close attention to that second step. That's where the magic happens and where most of the exam questions come from.
Okay, let's zoom in on that second step, deducting unrealized income. This is where the exam questions get tricky, and it's where a lot of people lose points. So let's break down the key items you absolutely must know how to filter out.
To really ace this, you need to think like the SEC. And their philosophy is simple: cash is king. The whole point of this whole reconciliation is to get rid of what we call paper profits. If the company hasn't actually received the cash or isn't certain to receive it, you just can't pay it out, period.
Okay, this right here is your ultimate cheat sheet. Seriously, screenshot this, write it down, do whatever you need to do to memorize this table. It covers the most common and tricky adjustments. For example, that equity in an associate, that's a classic exam trap. Yeah, you record the income, but you don't have the cash until they actually pay you a dividend. And same for fair value gains. It's great that your building is worth more, but that's not cash until you sell it, right?
And don't forget this other major adjustment: treasury shares. When a company buys back its own stock, it's spending cash that could have been used for dividends. So it makes sense that the cost of those shares has to be deducted to find the true amount that's available for distribution. It's that simple.
Okay, time to switch to high-speed mode. We're going to do a lightning round review to really lock this information in. Maximum retention, zero fluff. This is your final scan before you go test yourself on this.
First up, the big picture concepts. It all starts with the trust fund doctrine. That leads to the rule about unrestricted retained earnings. The current guideline you need to know is MC 16-2023, and the whole point of this entire process is to filter out those paper profits.
Next, your hit list of deductions. These are the big 5. If you see any of these pop up in an exam problem, a light bulb should go off in your head, and your first instinct should be to subtract them from the unappropriated retained earnings balance.
And there you have it, your complete roadmap. So next time you're looking at a financial statement, don't just see the numbers. Ask that bigger question. How does this one calculation shape every major decision a CEO makes? That's the difference between just passing the exam and truly thinking like a CPA. Keep practicing, and you are going to nail this. Good luck!